Well, good morning. This is Bill McCready for Futures Trading Secrets. This video will give you an example of how our trading system works. First, I want to point out that the dotted lines represent the overnight Globex on the E-mini S&P. And you can see we closed yesterday at about 946. The market came down, tested a low, and then went up to a high overnight. And just before the market opened, dropped a little bit. Now, Bernanke was speaking today. So what happened is you can look down here with our short-term indicator. These are proprietary, by the way. That gives us a divergence. Here's a higher high on the price, equal high on the indicator. Tells us the market is going to go down. So and it started down, and right at the open, it continued down with our short-term indicator under its moving average. As it continued to drop all the way down, you would have picked up points from 954 to 948. Now we get out when we get this arrow. These print automatically, and they represent previous lows and Fibonacci numbers, Pesavento numbers, support and resistance, all rolled into one indicator. This is an exit signal. Now generally a price, if it's going to continue down, will go up and bounce off our two moving averages, which generally we're very close here. I'm going to move the chart to the left a little bit and show you what else happened. After we had this second fall down, and this was right at the pivot point ultimately for today, we have another divergence right here on the short-term indicator. And our first target when we're counter trend here is almost always these moving averages where they cross. Now this went a little further, but you basically have 947 to 950, another 3 points. Now once you get this turn and this arrow, you can see that we have a continuing divergence, or what's called a hidden divergence, with the lower high price and the lower high on the indicator, and it's under its intermediate momentum and everything is down. So this is an excellent place to go short. Now at 951, we finally get out at this final arrow at 945. That's 6 points. Now what do you do? Well, again, we're looking for the divergence on this indicator, and I'll talk about it in a second. Watch what happens. Price bounces again, and this time from 945 to 951, another 6 points. Now, by my calculation, it's only about 1040 here. You've been in the market for 40 minutes, and you've gotten 22 points. Now this indicator is not a stochastic or a MACD or anything else. It is a third derivative of the price, which says it shows perfect divergences when to play them. What this means is you're measuring the slope of the slope of the slope of the price, and you're getting perfect divergence signals along the way. We even had a reverse here where we had a lower low on the price and an equal low on the indicator. So you could have had a double whammy right there. This is Bill McCready for FuturesTradingSecrets.com. Hope this helped your trading. Thanks a lot. We'll talk to you soon.